This conference will now be recorded.
Hello everyone, my name is Yasser Galfraz and I'm your tutor for today's session, uh, UK taxation. We will continue to our next session. Obviously, yesterday we left on halfway because of long lecture. So how's everyone? Everyone is fine. Are you fine, Nizar?
Yeah, I'm good, thank you.
Okay, good. So uh, we will start from a taxable total profit. So in our last lecture, can you see my screen or can you hear me properly? Any
Yeah,
issue?
no, not at
Okay.
all. All good.
So in our last lecture, you know that we discussed yesterday's scope of income tax. Income tax, is imposed by the government on people's income, wages, salaries, investment, and other sources of income. And then we discussed chargeable gain and capital gain tax liabilities. So chargeable gains and capital gains tax is a tax on profit from the disposal of certain assets such as a share and property. I'm just giving you a quick highlights. Okay,
Yeah,
so basic principle of calculating gains and losses. This involves understanding the basic principle of how capital gains and losses are calculated. Then we discussed scope of inheritance tax. So inheritance tax, is a tax payable on certain transfers of value made by an individual before or after death. Uh, then we were discussing corporation tax, which is a tax on the profit of companies and other entities in the UK. So it is based on the taxable total profit of the entity. So which are calculated using the small rolls as those used for income. Then stamp taxes or stamp duty. Stamp duties are taxes on the transfer of certain property, right, or interests. So then VAT, value added tax, we discussed value added tax, as you know, that is a tax on the sale of goods and services in the UK. So it is charged at different rates uh, depending on the type of goods, services, being sold. So this was we left here somewhere. Yeah. So can you see my screen now?
yeah, yeah,
Okay. So, opening years, there are special basic rules. Now today's we will discuss our second lecture of this session. So, continue, that to business pages. So, basis period roles in opening and closing years. So, opening years, basis period, date of commencement, 5th of April. So here second, if the counting period ending in year two is a 12 or more months long, use the 12 months to that date. So if the accounting period ending in year two is less than 12 months, a long, use the first 12 month of trading. So if there is no accounting date in year two, use the year itself. 12 months to accounting date in 3 year. So tax year is usually the period of time for which a person or business prepares their financial accounts that the within the tax year. So, for example, uh, if sole trader sole trader prepared their financial accounts up to 31st of December each year, then the basis period for the 2016-17 tax year would be the year ending on 31st December 2016. Okay, so there are special basis period rules on opening and closing years. Uh, so the basis period for tax year typically start on the 6th of April. Okay, and ends on the following 5th of April, as you know. So if the financial accounting period ending in year 2 is 12 months or longer, then the basis period for the tax year will be that entire accounting period. So if the financial accounting period ending in year 2 is less than 12 months long, then the basis period will be first 12 months of trading. If there is no specific accounting date in year 2, then the basis period will be entire year, uh, tax year itself, 6th of April and uh, to 5th of April for the next year. So which is year 3, the basis period will be the 12 months leading up to the accounting date is in that year. So here, if a business has been taxed twice on any profit during his early year, those profit are known as overlapping. So here is we are talking about the basis period example. Here you can see some examples like Nitin, who has been trading for many years, prepare account to 30th June each year. So overlap profit of 9,000 arose when Nitin started trading. Results for recent year have been year 30th of June 50,000, and then 30th of June 16 70,000. So on 30th of September 16, Nitin ceased trading. Profit for the 3 months to 30th of September were 15,000 pound. What is the Nitin's final trading profit assessment? So here you can see that the assessment for 1617 is gone. So is 30th of September less overlap profit 76,000 pound here, and then the trade ends in 2016. So 1617 is the final year. The basis period for 1516 would have been in uh, 30th of June. The basis period of 1617 therefore runs from July 15. So overlap, basically overlap profit. If a business has been taxed twice on any profit during its early years, those profit are known as overlap. Okay, if business has been taxed twice uh, on any profit during its early years, so those profit are basically known as overlap. So these overlaps profit can be relieved upon cessation of the business, as he ceased his business in September 2016. So if the final year of the business, any overlap profit are deducted from the profit for that year. So when assessing a business tax liability, it is important to ensure that the calculations cover the entire lifespan of the business. So this can be done by comparing the total taxable profit after accounting for any losses to the total actual profit, or after calculating any actual losses. So it is also important to consider that as profit adjusted for tax, as this may that differ from the actual profit due to various tax adjustment, such as a capital allowance, or what we call depreciation. So uh, if you look at calculation, that Nathan's final trading profit, that basis we need to determine, the basis period of the final year, which is the case of 1617. So period of 1516 would have been the year ending on 30th of June 15, and there, that therefore the basis period for 16-17 runs from 1st July 2015 to September 2016. So the final year's assessment is calculated by subtracted Nathan's overlap profit of £9,000 from this is here, overlap profit £9,000 from his profit for the period of 1st July 15 to September 30th 2016, which is here 76,000. So 70,000 for the year ending 30th of June 2016 here, and plus 1,500 for the last 3 months of trading, minus 900 9,000 for overlapping profit. Okay, any question?
No, no, it's okay.
Okay, so change of accounting date. Uh, when that year of changing is equal to test year with the next accounting date, when there is a change in accounting date for a business, the year of change is the tax year in which the new accounting date is adopted. So for the year before the change in accounting date, the basis period is the period up to the old accounting date. Okay. So for the year of change, the treatment of overlap profit depends on the length of the accounting period ending in the year of change. So if the accounting period is less than 12 months, a new overlap is created starting from the year before the change. So if the accounting period is 12 months or more than 12 months, then the overlap profit from the previous years are, relieved. For the year after the change in accounting date, the basis period starts from the day after the end of accounting period in the year of change and ends at the new accounting date. So NICs for the self-employed. So class 4, that again he's discussing about national insurance contributions for the self-employed. Class we discussed. You remember that Nizar, we discussed classes for 1, 2, 3, and class 4 for national insurance contributions.
Yeah, yesterday, yeah.
Yeah. So here he's talking about 10 ICs for self-employed, 9% of profit between upper and lower limit, main rate 2% above upper limit, and then class 2 flat weekly amount 2.80, that's 16 and 17. So
Hmm.
upper limit is 43,000. Is it still same rate? Any idea?
Um, yeah, it's still the same, right?
Yeah, yeah, okay, okay. So and lower limit is 8,016 unless that profit are below the small profit threshold of 5,965. So basically class 4 insurance are calculated as a percentage of profit between the upper and lower limit, with the different rates of profit above the upper limit. Like
Hmm.
he's talking about 16-17 tax year, the main rate is 9% of profit between the lower limit, which is 8,060, and upper limit is 43,000. So any profit above the any profit above the upper limit are subject to additional 2% rate.
Hmm.
So class 2 flat weekly amount. So class 2's in national insurance are flat weekly amount, which is rate of £2.80 per week in the 16-17 year tax. So well, if profits are below the small profit like 5,000 965, okay, in the 2016 years, there then no class 2 national insurance contributions are payable. So next is individuals carry forward for of trading losses. So trading losses in a basis period is calculated in exactly the same way as taxable trading profit would be. So the loss must then be allocated to the correct year, tax year. So for example, a loss for year 31st of December would be allocated 2016-17. So uh, when trading loss occurs in a basis period, it is calculating in the same way as a taxable trading profit. So must be allocated the correct tax year, such the allocating a loss for then the year ending 31st December 2016 to the 2016-17. So if the loss is not, relieved in any other way, it can be carried forward and deducted from the first available profit of the same trade. So it is important, that it is very important to note that losses cannot be saved up and used at a later time that suits the trader. Losses may be
Sorry,
carried forward. Sorry,
sorry. Did you say it cannot be or it can?
cannot
Okay.
be saved. Okay, losses may be carried forward for any number of years, but if the trade changes, there is no further relief, available for the carried forward loss. You
I
understand
see.
that?
Yeah. Yeah.
Yeah.
Yeah.
So deductions from total income. So to relieve a loss, it can be deducted from the total income uh, of the tax year of the loss and or the percent preceding tax year. The whole loss must be deducted if there is income available to absorb it in the chosen tax year of relief. So the loss can also be set against gains of the year of the loss and or preceding tax year. So
Mhm.
it must be set against income of the relevant year first. So also it is very important to consider the personal allowance or annual exempt amount, before recommending this relief, as it may lead to wastage of these amount, which could be a significant tax planning point.
Yeah.
So, for example, he's giving example here that Sue makes up accounts to 30th of September. Recent results are, if you look at 50,000 pound, then 19 sorry September 17 25,000 results for the tax year, 50,000 pound loss and profit. So here, that 30th of September and incurs a loss of 50,000 and profit of 25,000. The
Hmm.
loss are, can be deducted from the total income of 2016 and uh, 15 and 16, 2015 and 16 as well. So, and the profit for 17 at 18 can be subject to taxation after deducting the carried forward loss. Okay.
Yeah. In this example here, you've got obviously in 2018, 17, 18, we made a
Yeah.
profit, but then we've taken a relief, deducted relief from it, so that will kind of put us in a loss again in 17, 18 of 25k.
But
Does
as
that
he said,
mean
sorry, yeah, carry on.
does that mean the remainder of the loss will be carried forward, or you
Yes,
can? Okay, so
exactly,
that,
carry forward. As I said, that you can carry forward as many
mhm,
as years, but you
okay.
have to save, you can carry forward the loss. Okay.
So I can carry forward the remainder of 25k
Yes,
loss to the next financial year, 19, it's 18, 20, 19.
yes, 20 and 19.
Yeah,
But it
okay.
must, set against income of the relevant year first. Okay.
Of course, yeah. Okay, okay.
Okay. So companies are trading loss. uh, any idea about anything comes up in your mind about trading losses or anything?
Um, I mean, not really. It's
Yeah,
I'm not
it's
sure.
it's exactly what it says. Trading losses are the losses made by a company in its trade. Okay, so a company that incurs a trading loss has, several options to relieve. The loss can be set against other profit of the same accounting period before the
Mm.
deduction of qualifying charitable donations. So
Yeah.
any remaining loss after this can be carried forward. Here
Right.
is your, you understand now. It says any remaining loss after this can be carried forward. So
Yeah. Yeah.
the loss can be carried back and set against profit of the previous 12 months before the deduction of qualifying, charitable donations. So any remaining loss after this can be carried forward.
Hmm.
So the loss can be carried forward to set against the first available profit from the same trade.
Okay. And what we say same trade, that mean the business hasn't changed
Yes.
the like if they still carry on with the same service, but if they change, for example, what they're offering, then they can't carry that loss forward.
No, they can't, because obviously they will
Yeah.
show as a new business or different, the trade. You know
Yeah. Yeah.
that when you make an accounts or when you work on the tax system, you specify the different trades and different, areas of business.
Yeah. Yeah. Of course.
So, companies trading loss, tax relief one and two requires a claim to be made. Company can choose to claim relief one only. So, tax planning, basically, that uh, here is talking about tax rules allow a company to relieve its trading losses in three ways. The first two methods, which involve setting the loss against other profit of the same accounting period or the previous 12 require months require a claim to be made. However, relief 3, you know, is given automatically, allowing the loss to be carried forward to set against the first available profit from the same trade. So optimize to optimize, tax planning. It is recommended to aim for the relief or losses against profit that incur the highest tax rate. So but if applicable, it is also important to consider the timing of relief and the impact on any qualifying donations for companies or the personal allowance, for an individual which may become unrelieved. Have you ever worked for charities? Do you
No.
work for charity? Oh, no.
No, I
Okay.
haven't. Yeah.
Okay. So basically, when you work for small businesses, tax
Mhm.
returns, or which kind of services you provide?
For small, uh, well, I mean,
Yeah, I mean that you work for you obviously you don't work for a capital or inheritance tax. Your main tax area is a VAT. Is that right?
yeah, yeah, VAT, self-assessments, these stuff. Yeah.
Yeah, yeah. So you will see that when you can adjust their losses. Okay. So most of
Mm.
people when they comes to you, obviously, uh, most of time you don't. If you look at very small businesses,
Mm.
you will not see very often. That you will see profit, but they show their losses as well, which you can adjust. Or carry forward.
Yeah. Yeah. 100%. Yeah.
So companies other losses. Capital losses only set against current or future gains, never income, cannot be carried back. So, capital losses can only be set against current or future capital gains and not against any kind of income. It is not possible to carry back capital losses to set them against previous years
Hmm.
gains. So it is important to consider the timing of the any capital gains and losses. So as well as any available exemptions for reliefs. So in order to effectively manage the overall tax liability.
Yeah.
So here he's giving a performer, that trading loss performer. Uh,
Hmm.
if there is a loss, brought forward from a previous year, here if you can see that. it can be set against the trading profit for the current year. Okay, so any remaining loss can be carried forward to future loss.
Yeah.
Net changeable gains, total profit less loss relief current year carry back, and less relief and taxable total profit can be claimed for current year or the previous year, but not both. So any qualifying that charitable that donation
Mm.
qualifying charitable donation, that here KOCD relief, so less, and taxable total profit. So the company can also be used to reduce this the taxable profit. It is important to consider the timing of relief and the impact of any wasted personal allowance or annual exempt amount. So loss relief or loss relief planning, earlier relief, cash flow advantages of earlier relief, tax saving, offset against total profit is FY 2016 and period years, tax 20% rate will save more tax than offset in 2017 tax rate 19. So basically save more tax, that offsetting losses against total profit in 16, and prior year's tax rate 20% may be more beneficial than the offsetting losses in 2017 tax rate 19%. So it is very important to consider the possibility of wasted QCD, that charitable donation relief, if there are no profit left to offset against.
So the only basically it can't be carried forward is that the charitable donation. It's the
Yeah, no.
only.
If no profit remains to against offset against, yeah, no, you can't carry forward then.
Yeah. Okay.
So loss relief, a loss relief of the property losses. So loss relief for property losses can be used to set off against total income before that QCD qualifying charitable donations relief in the current period. So if that excess, if there are any excess losses, they can be carried forward to set off against total income, that before QCT relief in future period. So for capital loss, they are automatically set against current years. Okay, uh, if there are any excess loss, they can be carried forward to set off against the first available future gains. Capital loss can only be relieved against gains and cannot be set off against income. So here analyze chargeable gains and capital gains tax liabilities involving overseas aspect of organizational activities. Uh, you know that you never worked on capital and gain tax, but I think so when you're doing large practicing like a CAs, chartered accountant, they do. Okay,
Hmm.
but obviously you studied CA, ACCA. Okay,
Yeah.
have you studied tax papers there, or tax exams, or have you qualified tax exams?
Not the advanced one. No.
Yeah, but if you look at that IFA, it's my point of view. I'm not sure because I don't know much about ACCA, but I think so that IFA is discussing more widely about taxes. Okay, this is a
Mm.
one reason. They are uh, their topic is more you know uh, uh, about there are three subjects. I don't know you are studying all three of them or not. Income tax, personal business tax, and then again UK and business taxations.
Hmm.
Okay, so their focus is because obviously they have a separate status of uh, tax advisor as well. Okay,
Yeah.
so they more, that they are they're focused. They obviously they are their first topic is accountancy, but they are focused at the same time they are focused on taxation as well.
Hmm.
Mhm. Yes, so analyze chargeable gains and tax liabilities involving overseas aspect of organizational activities. So in order for a chargeable gains to be realized, three component must be uh, present. First is a chargeable disposal, chargeable person, and chargeable asset. So chargeable disposal refers to actions such as selling, gifting, destroying assets. Okay, then chargeable person, like this can be either uh, individuals or a company. Okay, then chargeable assets, most assets are considered chargeable, but there are some exemptions, such as like cars and certain that charitable rich horses.
Hmm.
Then is basic calculation or computation for individuals. Compute a chargeable gain. The following steps should be taken. Determine the proceed for the sale or disposal of here. Yeah, disposal of assets or the market value in the disposal was not made the arm's length. So subtract the cost of asset, uh, including the original cost or market value, if used a proceed enhancement expenditure that improve the asset. The incidental cost of acquisition, the resulting amount is the chargeable gain, which is subject to capital gain test. So it is very important, that certain reliefs and exemptions may be available to reduce the amount of the chargeable gain, such as the annual exempt amount, main residence relief, or entrepreneurs relief. So CGT for individuals. When computing an individual's taxable gains, the capital gain tax annual exempt amount of £11,100 must be deducted. The capital gain tax rate is 20%. Okay, and for higher or additional rate, taxpayer and 10% on taxable gains up to the amount of unused basis basic rate band, with the 20% being charged on the excess. So for gains on the disposal of residential properties, excluding your remain home, the rates are 18%. Uh, he's is not talking in detail, but there is a 20%, or rates are 18% or 28%. So the due date for capital gain tax for the year 16 17 is due on 31st of January 18.
Hmm.
So here is a quick example. If that's made taxable gains, here zoo made gainings of 13,000 pound in 2016-17. She had brought forward capital losses for if of 8,000 pound. So brought forward capital losses of 2,000 pound will be set off in 16-17. So the remaining losses will be carried forward in 17-18.
Hmm.
So he's not no, he's not, I think so. Yeah, he's not calculating, but that 13,100 pound, but she also had a brought forward capital losses of 8,000 pound. Okay, of these losses, 2,000 can be set off against her uh, chargeable gains in 16, 17, and the remaining 6,000 pound will be carried forward to future tax years. 6,000 will be okay. So by utilize capital losses, taxpayer can reduce their overall tax liability, uh, and potentially save money. So it is important to keep careful records of any capital losses incurred and ensure they are claimed in the correct tax years to maximize their benefit.
Mhm.
So here is computing gains and losses for a company businesses. The period of tax year is normally the period of accounting ending in the tax year. Okay, and then opening years there are, I think so. We just I'll move forward. Yeah, here loss for individuals, and then computable gain and losses for a company. So to compute a chargeable gains for a company, the following steps are taken. Determine the proceeds received from the disposal of the assets. So this could be the actual proceeds or the market value of the asset in the case of gifts, and disposal to connected person after deducting any cost of disposal. So deduct the cost of the asset. Uh, this includes the original cost or the market value if that was used as a proceed for the person who sold the asset to the company. Enhancement expenditure that was reflected in the state and nature of the asset at the time of disposal, and incidental cost of acquisition. Calculate the indexation allowance which is only available to company, which is only indexation allowance, which is any idea about expend indexation allowance?
No, no.
Okay. So indexation allowance, if you hear, will be given to your assignment, runs from date of acquisition or date expenditure multiplied by indexation factor.
Hmm.
So calculate the indexation allowance which is only available to companies. The allowance adjusts the cost of the asset for inflation, so that the gain is only taxed uh, on the real increase in value rather than the increases due to inflation. So deduct the indexation allowance from the cost to arrive at adjusted cost. Subtract the adjusted cost from the proceed to determine the chargeable gain. So chargeable gain is then subject to corporation tax at rate of 19% as per 2022 and 23.
Hmm.
So part disposal, and then computing gain and losses for company. uh, you know indexation allowance is calculated by multiply by expenditure by the indexation factor. So then disposal, part disposals, when you make a part disposal of an assets, obviously it's a very basic thing which you, I think so, when you studied your everybody, everyone is who's accounting student who knows about disposal of assets. So when you make a part disposal of an asset, you can only make into account part of the cost of the asset. So the costs that are attributable solely to the part disposed of are taken into account in full. So for other costs, you need to take into account like A plus B. So A is the proceed of the parts sold, and B is the market value of the uh, part retained.
Mhm.
Here is a giving an example. If Peter, owns land that originally cost 30,000 pound, and he sold a quarter interest in the land for 18,000 pound, with incidental cost of disposable of 1,000 pound, and the market value of the three-quarter share remaining is estimated to 36,000 pound. So the chargeable gain is, calculate what is the chargeable gains. So chargeable gain is calculated as, that follow. If you look, that below, proceeds 18,000 less incidental cost, here of disposable 1000 less 18, plus 36 multiplied by 30, and chargeable gains will comes up about 7,000 pound. So 18,000 pound is proceeds, then 18,000 pound plus 36,000 pound, three-quarter share remaining is, estimated to be 36 multiplied by 30, and the chargeable gain will be, that part on land they originally cost, which is 30, and chargeable gain will be 7,000 pound.
Mhm.
So chattels, any idea about chattels? Or
Horses. No, I mean, I haven't dealt with one before, no.
yeah, again, you can say that here is says a chattable, as it says, movable, tangible.
Hmm.
Normally we known as, tangible and intangible assets,
Hmm.
like a
Yeah.
fixed asset and liquid asset. So chattel is an item of tangible movable property. For example, he's giving example a painting. Gains
Hmm.
on charitable sold of gross proceed of 6,000 pound or less, and wasting charitable are exempt.
Hmm.
Minimum gain on charitable sold for more than 6,000 pound, where the cost was less than 6,000 pound, is gross proceed. So losses and chattels sold for under 6,000 pound are restricted by assuming the gross proceed to 6,000 pound. So charitable sold at more than 6,000 pound, the maximum gain allowable is five third, the gross proceed 6,000 pound. So given that the cost was less than 6,000 pound, on the other hand, any loss from the sale of tangible with gross proceeds of under 6,000 pound is limited by assuming the gross proceed, uh, as it says, to be 6,000 pound. Connected person. So disposal between connected persons are deemed to be for the market value of the assets. So when a disposal is made between two connected person, it is considered that the assets were sold at market value. So if a loss is incurred on such a disposal, it can only be set off against uh, chargeable gains and disposal made to the same connected person. So for the purpose of this rule, an individual is connected to their spouse or civil partners, relatives, as well as their own relatives, including sibling, brothers, sisters, and the lines descendants, as well as their spouse or civil partner, wife, relatives. So this rule does not apply to no gain, no loss. Disposals that involve spouse or civil partners. So here, if you see that spouse and civil partners disposal between civil partners do not give rise to gains or losses. Okay, example, that Joe buys an assets for 20,000 pound, okay, and gives it to his wife Julie. When its market value is 30,000 pound, deemed proceed 20,000 pound less cost 20,000 pound, no gain, no
Mhm.
loss. Okay, so if Joe transfers an assets to his wife Julia with an original cost of 20,000 pound, uh, but a current market value of 30,000 pound, okay, the deemed proceeds for a Julia would be 20,000 pound, resulting in no gain or no loss.
Mhm. Okay, okay.
So examine the next is uh, application of, now is talking about inheritance tax, relating to the principles of valuations and the reliefs available, transfers of property to and from trust, overseas aspect of or organizational activities, and further aspect of administrations. So as you know that inheritance tax, any property or anything's transferred from someone else or from your fathers or your families or your anyone's. So the most essentials, in inheritance tax essentials are transfer of value, chargeable property, chargeable person. So transfer of value, capital, gift, losses to estate, chargeable property, all assets, no exempt assets for inheritance tax. So chargeable persons, originals. Okay.
Mhm.
So the basics, occasions of charge, death, gift within 7 years, pre-death, other lifetime gifts. So inheritance tax is charged on the transfer of value of all assets from a chargeable person to another person. Where the transfer result in a loss to estate, all estates are considered chargeable property, and there are no exempt assets
Mhm.
for IHT purposes, inheritance tax purposes. So chargeable person including individuals and sometimes trustees, uh, and personal representations, uh, for deceased persons. So he's also talking about chargeable basics as well. Value of assets owned by an individual known as chargeable person, chargeable property, any transfer of value made by during the lifetime or upon the death of an individual is subject to inheritance tax. And include, inheritance tax include deaths, gifts made within 7 years before death, pre-death, before death, and other lifetime gifts known as chargeable lifetime, transfers, CLT, chargeable lifetime transfers.
Mhm.
So all assets, including capital gifts, are subject to inheritance tax with no exempt assets. So the individuals transferring the value of the asset is considered the chargeable person for inheritance tax purposes. So here is, that what we just discussed, definitions, lifetime gifts,
Mhm.
chargeable lifetimes, uh, chargeable lifetimes transfers, which refers to any gift made by an individual or to another individual or certain trusts, then is not exempt or potentially exempt transfer. So next is PETs, which is a potentially exempt transfer, which refers to gift made by individuals that may be exempt from inheritance tax if the donor survives for at least 7 years after making the uh, gift. Occasion of charge. So death, gift within 7 years, pre-death, other lifetime gifts. So tax rates, you know, tax rates could be uh, charged at the date of the gift and paid by the donor. So all assets are chargeable property for inheritance tax purpose, and there are no exempt assets, as we just said. So here, inheritance tax computations and to transfer of value, specific exemptions, chargeable transfer, tax calculations, chargeable transfer, dimension in value, principal, spouse, civil partner, gift, marriage, you know, and annual lifetime tax. Uh, 20% CLT where donor is to pay tax, or 25% uh, where donor pay tax. So inheritance tax, one can utilize the available exemptions and reliefs. It is also possible to gift assets during one's lifetime, provided that the donor survives for at least 7 years. So TAPA relief may be applied if the donor survives for at least 3 years. Annual exemption is also available, can help freeze the value of gift.
Mhm.
So here is then I did I miss something? I was looking. So anyway, I was talking about I'm looking for married couples and civil partners. Anyway, here I will just quickly splash on married couples. Married couples and civil partners can benefit from a transfer of deceased spouse. This means that unused proportion of the NRB on the first death can be transferred to the surviving spouse or civil partner and applied to their NRB inheritance tax at the date of their own death. The same applies
Mhm.
to the residence nil rate band here. That nil rate band available. So the same applies to the residence nil rate band. However, it is important, to note that the claim of for this transfer must be made within 2 years of the second deaths.
Mhm.
For
So
future, sorry, yeah, carry on.
inheritance inheritance tax is basically only applies if, I mean, it doesn't apply if that's your main residence, right? So it's like if me and my child, let's say, live in a house, I passed away, and then the house will be transferred, or kind of, or my son will inherit the house. But because he lives in it, he doesn't have to pay inheritance tax.
Yes, yes, it is. It's only applies if somebody, that your relatives, your sibling, your son's kids, if not living there. Okay.
If they're
So
not
if you are
living there.
transferring, yes, if you are transferring into their name, you understand
Yeah,
that, or
yeah.
as a gift or whatever, so that would be a inheritance tax will be applied. Okay.
Hmm. Okay.
So further computation, it is not a very complicated. It is a very straightforward, basically. Inheritance tax
Yeah,
in
yeah.
my view. As you understand, you got the point. It's not applies on any person which lives on the same property. Okay, because he already own the basically property. Okay, even if
Yeah.
he's your son.
Mm,
So. Further computational calculation points, gifts in 3 7 years pre-death get taper relief. So
mhm,
over 3 but less than 4 year, 20%, 4 but less than 5 years, 40%, over 5 but less than 6 years, 60%, over 6 but less than 7 years, 80%. So any lifetime tax paid on CLTs falling in 7 years pre-death can be credited against death tax, but cannot lead to repayment.
mhm,
So and further computational point for tax on gifts in 7 years pre-death. So taxable amount at 40% less tapper relief, chargeable after tapper relief or any relief, then less lifetime tax paid, uh, CLT and inheritance tax due. So here is a summary of exemptions and relief. So annual exemptions, £3,000 per year, carry forward 1 year only, use current before brought forward, inter spouse civil partner exemptions, okay, lifetime gifts and death. So small gifts £250, total gifts per donee per tax year, marriage exemptions £5,000 per parent, £2,500 per grandparent, party to marriage £1,000, others. So normal expenditure out of income must be able to maintain standard of living, must be habitual. Death estate, so freehold property, less repayment, not an endowment or mortgage. So life insurance policy, proceeds not current, and all other assets, cars, shares, bank, building society, or saving accounts, individual saving accounts, uh, debts due to deceased, less outstanding debts incurred for valuable consideration, and funeral expenses as well. Okay, so exempt legacies, gross, chargeable estate. Death estate, gross chargeable estate, less residence, nil rate band of death, as you know that we discussed previously, nil rate, uh, you know, uh, band at death, less gross capital tax in 7 years prior to death. So taxable amount, inheritance tax payable at 40%. Well, to be honest, this is too much in my point of view, 40%, isn't it?
Is
But after deductions, even they are deducting funeral cost and these kind of but things, but still it's 40%.
nah. It's, but then
Yeah.
I think it only applies if the house value is over 300 and what 20, I think, or
Yeah, yeah,
370.
it is 325.
Yeah,
325
yeah, yeah,
approximately. So it is it in many areas, especially in London, if you look at in UK scenario, in London or the surrounding areas, most of prices are over £300,000. Like,
yeah,
look, if I'm talking about my area, is houses prices are less than even 2 grand. Okay,
yeah.
200,000 pounds. So residence nil rate band, once you are talking about residence nil rate band, okay, applies to
Mhm,
death on 6, 7, 4. Here it says applies to death on 6 April 17 or later. Available if the deceased estate include at a home which is left to direct descendants. Here, that, for example, children or grandchildren was one you were talking about. If they are living in the same property. Okay,
mhm,
so residence nil rate band. So maximum nil rate band is £100,000 for tax year 17 and 18.
yeah,
Payment of inheritance tax between 6th of April and 30th of September, following 30th of April. 1st of October, if transfer between 1st October to 5th of April, 6 months after the end of the month of transfer. So, the payments of transfer chargeable as a result of death 6 months after the end of the month of deaths. So, additional tax due on, CLTs within 7 years pre-death, 6 months after the end of the month of death. So,
mhm,
estate at death 6 months after the end of the month of death. So, or if earlier on delivery of estate accounts to HM or C. Inheritance tax planning uses available exemptions and reliefs, gift assets during lifetime. Donor may survive 7 years, tapper relief if survive 3 years, annual exemptions available, freeze value of gift. So married couple and civil partners, we just discussed, that married couple and civil partners. So transfer of deceased spouse unused, un or be unused nil rate base, proportion of nil rate base on death uh, can be transferred to the spouse or civil partner on their death.
Hmm.
Uh, Date of second death. So applied unused proportion of nil rate based on first death applied to an nil rate base at death of second death must claim within 2 years of second death. The same applies to the residence nil rate. You know that the same applies to the residence nil rate band.
Hmm.
So here is talking about there is an exercise, I think so, is from ACCA, uh, evaluate income and income tax liabilities in relation to trusts. You can check this one if you want to. Otherwise, assess the use of stamp taxes in the taxation system, and you know plenary further reading, ebooks and articles on Moodle. You got the Moodle access, learning management system, password and login.
I do, yeah.
Yeah, there would be a, there is available these, income tax and articles and books and some links. And
Yeah.
also, I will send you a sample assignment, but I think so there is one available as well. Okay, if you, I don't know whether you have checked or not, but one is available there as well.
Hmm.
But I'll send it to you today. Okay, sample assignment.
Yeah, that'd be great.
So
I
that's
do.
it.
I do have a
Yes.
question, just in terms of the inheritance tax and so, question about inheritance tax. Let's say somebody has is liable to pay inheritance tax, but then he doesn't have the actual money to actually pay it. But so then they go into the option with selling the house to pay
Yes.
the inheritance tax. So let's say if they sold the house and they made a gain, would they be hit with two taxes, capital gain and the inheritance tax?
Yes, because the one is for transfers and one is you are inherited from someone else. Okay, but if you are in same property, obviously, as we discussed, that you don't need to pay inheritance tax.
No, let's say if you're not, and if you inherited the property from,
Your
a
parents,
relative. Yeah,
yeah.
exactly. So then, would you be hit with two taxes if you sold the house that you inherited to pay the inheritance tax, and then you've made a profit on that on the, from the sale? Would that mean you're liable to pay both taxes, capital gain, and
Yes, yes, you are liable to pay both taxes unless you are exempt, not exempt, that
unless
exempt.
you're exempt? Yeah, yeah.
Yeah,
So
but most cases, that if, again, I'll say that if you get inherit from your father and living in the same property, you will pay obviously capital gain tax, but not then you have to pay both of them unless
yeah,
in some, that you are exempt in some, for some reason.
hmm, yeah,
Mhm.
yeah.
Too many taxes, too many taxes. Those are too many taxes. That,
I know too many taxes. Yeah,
you know so you see that 40%, if his house is for, let's say, just example, I know that 100,000 pounds are is not a payable amount, but see that if house property price is 100,000 pound, you have to pay 40%, that all, after all deductions or whatever expenditures and everything. So look
yeah.
at it is too much basically, you know
It is.
so
Yeah,
that's why, that people always look in, earlier we were talking about tax invasions, and people are using different kind of methods. So that is the reason they go to the, chartered accountants or accountants,
yeah,
so what's the point if you are selling your house for 100,000 pound, and you are getting 50,000 pound or 60,000 pound. Okay, or let's say even 70,000 pound. Okay,
Yeah, I mean
so
there's always different ways. So like I know something where they can assign it to a trust fund. So all their properties, they create a trust fund and then they put it in their kids' names. So then you know,
yeah,
they don't have
exactly.
they're not subject to inheritance tax at that point.
Yeah, and they use also spouse, that, partner, civil partner or wife as well. Okay,
Mm.
transfer into her name. There is some exemptions available, you know.
Yeah,
So you're
I mean legally there is always that obviously there is kind of ways um, to benefit from those exemptions. So then that's what the HMRC have created all these options.
yeah, yeah,
Rather
yeah,
than
definitely.
yeah, imagine if
The
they if
end of
sorry.
the day, HMRC is, that telling you that these are, the percentage of taxes, and same time they're telling you loopholes as well. You
Yeah,
understand?
well, yeah, yeah, because they is in a way it's just they really need to kind of make it easier for people. Otherwise, imagine if you're forced to pay the 40% regardless of no matter what.
Oh,
It
or
would be
not.
harsh. Yeah, exactly.
Let's say if is that, that's why, that in, as we discussed earlier, tax evasion, so
Yeah,
one is hiding tax, or hiding is illegal, but that using exemptions, or some other legal ways, like you were talking about offshore companies as well yesterday, I think so you questioned that. uh,
yeah,
I'm just talking about in a tax, why of it is a basically tax for tax purpose, low taxes, or that not paying any tax.
yeah,
Okay,
yeah,
so this is, main reason to, people use some other ways, illegal ways, but that's not a proper way. Always, if they pay their taxes, legally, uh, there are many options. They can they can get exemptions, or they can pay less tax.
yeah, exactly.
Anyway, this was the end of learning outcomes 1, and next weekend I'll see you at 11 for learning outcomes 2, inshallah. And that's it. If you have any question, drop me an email at, tutor-management at uh, ukversity at ukversity.co.uk. So
Hmm.
I'll see you next weekend at 11 o'clock. And
Yeah,
thank you very much for today. If you have any question, just that drop me an email.
yeah. Okay.
Thanks for today. Thank you very much.